If you want a simple and high reward way to trade, then continuation trading might be for you. In this class, I'm going to break down what continuation trading even is, how you can do it, and how you can basically ride any trend until it ends to catch multiple winning trades in a very simple approach to trading. We're not going to waste any time, so let's get straight into the lessons. The first thing to understand is exactly what we mean when we say continuations. So this class is geared around continuation trading, not reversals. Now, a reversal would be pretty much anywhere within this area of price action, where we see the market shifting from higher highs and higher lows into lower lows and lower highs. The reversal trading opportunities would come potentially up here, potentially in here, and most commonly in here, where we're basically taking advantage of this first shift in the market to enter into a reversal into the start of a new trend. But that's not the focus of today's video. Continuations are. Continuations are pretty much every other piece of price action that you can see here. Simply put, it's continuing through the trend. So this would be a continuation trading phase. And so would this second point just here. So we can eliminate the reversal, and the continuation areas that we're looking at today and the systems that you're going to be following and learning about in today's class is to trade continuations through existing trending moves. So during this move, where the structure is continually breaking into new highs, our trades will be from the lows that we form in this uptrend. So we're simply continuing the direction of the trade. Eventually, when the trend does come to an end and shift direction, this will be a phase of reversal trading, which we won't be involved in. In fact, likely we will be involved in it. We will probably get into a trade at one of these points and then potentially lose one of our positions as the market reverses. The idea with continuations is not to be right on every single trade, as it's not with any other form of trading, but it will allow us to be right multiple times before we are finally wrong. So if we continue to move with an existing trend, the only time that a loss is really going to come through, for the most part, is when the market reverses on us. So if we were to buy from here, we would be abruptly stopped out of this trade. We would lose, and that would be fine. We would then lead into a new phase of continuation trading, which in the downward trend would be looking to sell the highs that we form. So continuations are existing trending moves and just catching trades through moves that are already taking place. So this phase here is bullish continuation, this phase is bearish continuation, and this area in the center is reversal trading, which is not what we're going to be looking at today. Okay, so that is the basis of what continuations are. Now let's take a look at the entry models that we'll use to actually trade in this manner. Okay, so here's a look at the entry model that we're going to be using to get into continuation trades. Now we can see the overall premise of this idea is that we'll be taking this inside of a downtrend, okay? So we would need this to come from a bearish continuation move. We are first looking for a break of structure into a continuation in the downtrend. Then we are looking for a pullback to bring us back to an area of supply. We're going to show you this in a moment. You'll see how supply zones work, and you'll see how we're going to be using these for entries on a real chart. Once the market reacts to the supply zone, which is basically a consolidation area that created the large downward move that we are trading from, we are then looking at entering in one of two ways. The first way is what we can call a risk entry. A risk entry is where we just sell limit, so an order that will immediately enter you into a sell when the market hits the supply zone. If you sell limit here, your stop loss will then go above the previous lower high, and this way, unless the market changes trending direction on you, you are not going to lose a trade. So you'll only lose if the market reverses and invalidates your setup. This way is a good way to trade. It's very, very simple. You simply find the trending direction and then you place your order and allow the market to either run in your favor and you win the trade, or if it turns on you, this actually confirms a change into a high. So then you can start to trade the uptrending movement, providing that continues through. Now, the second way to trade is with a fractal confirmation. So take a look at this area here. We're basically seeing a small reversal format. We have a high, higher low, higher high, and then the market breaks down into a lower low, and then we are looking to sell this point here, or the first lower high that is really formed within this trending move. So here we actually use a small reversal to trade inside of the larger continuation movement. What this does is validate that this smaller price action is now also in a downtrend. If we picture what we see here, we have a high, lower low, lower high. So we know that this phase of price action is now bearish. If we pair that with the fact that the larger phase of price action that we're trading is also bearish, we basically get an extra layer of confirmation and clarity that the market is likely to move in our direction. Now, there are some things to note about these two different ways of trading. If you trade the sell limit approach, this approach here, you are going to miss way less trades because sometimes the market isn't going to come in for that fractal confirmation, which means that we may just do this and the trade that you were looking to take from the area of refined supply is not going to get hit. In an instance where this happens, of course, this is going to be a missed opportunity, but the entry here will be secured. So you're going to catch pretty much every trade that you do see. You're not going to have such a concern about missing out on opportunities. However, due to the fact that we are not refining with this example here, our risk reward is going to be slightly lower. If we take a look at these two entry models, the risk reward of the first is 4.72. The potential for the second is 8.4. So we actually get around 2x the profit potential on this setup than we do on the initial, the sell limit setup. So you're kind of balancing there between higher risk reward most of the time on the confirmation based entries, but the opportunity to miss trades also on the confirmation based entries. Now, the other thing is, of course, because you are working with additional confirmation, you'll have higher win rates for the trades that you do catch. So you might only catch 50% of the trades using confirmations that you would have caught if you used the sell limit entry. But you're probably going to win a reasonable percentage more. Because when you sell limit into every zone, you are open to the fact that the market may just completely reverse on you, where you'll get stopped out once your stop loss is hit. If you're waiting for this confirmation, the chances of that happening are considerably lower. Now, yes, of course, sometimes the market will trick you into a sell and then just break higher anyway. So you will still lose some trades here. This is not a guaranteed kind of magic bullet way to win every single setup, but you will pretty drastically increase the amount of trades that do work out. It just means that you're going to miss a few trades as well. So what we're going to do is backtest both of these approaches in real markets. Before we do that, I'm going to just jump over to the charts and show you a real example of this. And then we'll run through a little backtest and I'll show you the comparative results between this approach and this approach. Let's get to it. Okay, so here would be a solid example of a continuation trade using a confirmation-based entry, so the secondary format that we mentioned. Now we can see this market is in a downtrend, right? We're continually forming lower lows and lower highs. Just to zoom that out a bit, basically from this high downwards, we are making clear bearish movements. There are three different concepts realistically that we're going to be using inside of this system. Number one is market structure. That is just the idea that if the market is continually forming lower lows and lower highs, that it's in a downtrend, or if it's forming higher highs and higher lows, that it's in an uptrend. To mark that on this chart that we're currently looking at, we have a high breaking into a low here. This is kind of the first sign that we're moving into a downtrend. And then we have this low breaking into new lows from there onwards. And you can see that this is our high, but this is a lower high, and then this is potentially another lower high, which is where we would ideally be looking to sell. Now the market structure is purely for directional bias. Once we have our directional bias in mind, the other two concepts we need to consider are market efficiency and supply and demand. So market efficiency refers to open price ranges. Now, if we take a look at this phase of price action, just this small upward movement here, we don't have any open price ranges. We initially begin with this candle. The market then pushes up a little, but we have a wick that fills the range. So let's neaten this up a little bit. Basically, what we see here is that we have this slow chop, right? And basically every area that opens up is retested by price. So there's no significant open imbalance, right? Until we get to this point here. So this area between basically this candle and these candles up here, we see that where I've just marked out these red lines, between here is an open price range. That's what we call the imbalance. An imbalance is important because we always want to see these imbalances filled. So if we take a look back here, between this candle and this candle, we have the imbalance. Now, I'm not looking to sell from inside of an imbalance. I don't think that makes too much sense. I know there's a way of trading that called FVGs, but I prefer to see, and we do very often see, the imbalance completely filled. Which means if the market trades back up against that imbalance, like it did here, we would expect the market to come all the way to the top of the imbalance before then reversing. And you can see that that's what's happened in this example just here, right? So we always want to see the imbalance filled, And to identify an imbalance, we are just looking for an open price range, which realistically is just a price range that has been opened in the market that has no further wicks or anything leading into it. So just to give you some examples, this area between this candle and this candle is not an imbalance because this wick here filled the imbalance. And as you can see, it didn't trade from the imbalance, it pushed above the imbalance and then sold off. This area just here is an imbalance at this point in time after we had this sell-off, but now it is no longer imbalanced because the market came back up and retested the area above the imbalance, okay? If we take a look at the existing current trending movement then, from this to this is an imbalance, okay? So we would anticipate at some point for the market to come up, trade over the high of the imbalance range, and then trade lower. So that's the concept of market efficiency, because another name for these imbalances that we see in the market is an inefficiency, right? Efficient markets are like what we first looked at, where we have these clear choppy markets that have wicks filling in every single one of the open price ranges. An inefficient range or an imbalance range is where we don't have any wicks and we just have one large open candle or a few large open candles that haven't yet been filled in yet. That is the next concept we need to be aware of. Now, the final concept we need to be aware of for trading this strategy is going to be supply and demand. Now, a supply zone is basically an area of consolidation before a large down move. This big wick candle here, small candle body, wick, shows a consolidation. If we were to see this on a lower time frame, it's generally going to show that we opened at this level, we attempted to go higher, we attempted to go lower, and then we closed around this same level that we opened at, okay? That's why we have this small candle body. And this big push up and this push down are the attempts to go higher and lower before the market readjusted and closed near its open price. So this would be our consolidation before the large downward move. And we want to connect this wick to make sure we have the full range covered. So this would be our supply zone. Now, if we pair everything together, we have a supply zone with an imbalance leading into it, and we have a clear downward trending market. So because we are seeing a downtrend, we only want to sell, and we only want to sell then once the imbalance is filled and the supply zone has been retested, as we've seen just here. Now, there is one thing worth noting about this trade. We wouldn't really want to sell limit this trade. So the first of the two entry criteria I showed you would be risky for this position. It's not great for two reasons. Number one is the risk reward. If we were to sell here and we had a stop above the high, we'd have to have a pretty big target to get any meaningful risk reward. Realistically, I want to get at minimum 3-to-1 reward to risk ratio. So I need to make sure I'm risking $1 to make $3 or more. I don't want to do any less than that. So aside from having to have and being forced into having a large stop loss on this position, the other problem we have is that when we talked about the imbalance, if we were to take a look at the price move above, we can see that we actually have got some more imbalance higher in the price range. So if we sell limit here at this level, there is every opportunity that we come up towards this point, but we continue trading higher until the imbalances are filled and the market approaches supply zones up here. We could then sell off from this point, which would be totally valid. But it means that if we sell limit here at this first area, we're opening ourselves up to potential double losses or potentially taking a loss unnecessarily, essentially, before a winning trade comes through. So rather than using a direct sell limit approach into this market, we would prefer to use the confirmation-based approach. Now that we've had this hourly supply zone retest, we can actually take a look just up here, and we see that we have this consolidation candle. I always use the last candle before the impulse to mark supply and demand, before a large bearish impulse to the downside. If we then consider the structure inside of this smaller range, we can see that there has been a break of structure around this point here, where the market has now shifted from higher highs and higher lows into a lower low. So a better way to approach this trade would be with that fractal confirmation approach that we've already covered. And it's actually formed now at this point. We could place our sell limit on this supply zone. We could place our stop loss above for around 10.5 pips. And then we can determine our target. And to determine targets, we'll actually take a look over to the left and identify reasonable price areas that the market could come into. So we're looking for previous swing lows and areas of demand, areas of liquidity. So for simplicity's sake, we're going to take a look at this swing low first of all and see what this would look like in terms of risk reward for a position. This is probably going to be a reasonably low risk reward. we're getting just under a 3-to-1. So if we target that low, we're getting just under a 3-to-1. If we pull our stop to the high, a little bit down, 10.2 pips, which is still clearing the high, still a valid trade, we've actually improved our risk reward to that 3-to-1 ratio, okay? Now, obviously, in a real example, we may look for extended targets, or we may look to refine a way to get a tighter entry. But because I'm just showing you the overall basis of the trade and the elements we'll be using, I think this is fine for the example. So let's just recap on what we've got. We have a predominantly downtrending market. We then have an imbalance or an inefficient price range, which was formed just here. This imbalance was then filled when the market moved up towards this area. And by running up to this area, it traded into the supply zone, which is an area that we're expecting significant movements to occur from, in line with the overall bearish trend. So we have the first bearish movement, pullback to fill imbalance, retest of supply. We are now looking for that confirmational shift, and that is exactly what we've seen at this point here. So using the path tool, we can mark out this smaller trend. We've got this higher high, higher low structure. Then we've broken down into a lower low. Now we can look for pullbacks to sell into this market. And our target is just a simple swing low that hasn't been filled yet. So we can anticipate that the market will be likely to lead into there. Now there is another way we can find targets, and that is just simply to attack the local swing low. So that would mean you would take profits there. But obviously for a trade like this where we can't get massive risk reward out of it, it would be better to go for an extended target. I'm sure we will see some examples of this during the backtest though. So you can see now that whole entry criteria that we just marked up before moving over to this real chart has now aligned. We have a bearish trend, a filled imbalance, a retested supply zone, and now we've started breaking into that fractal confirmation, seeing the lower time frame agree with the high time frame. So what we can do now is just flick this market forward a little bit, and you'll see how it pans out. You see we come up, trade into the area of supply, and then pretty quickly sell all the way down to our target level. So our trade would have been executed about 1 hour after we prepped the setup, and then 5 hours after we entered, we have filled the target for a potential 3% return if you were risking 1% on this setup, which is generally the standard amount to risk per trade. So that is an idea as to how we actually follow through this confirmation entry criteria and this continuation entry criteria. We see downtrend, or if we were going the other way, we'd look at an uptrend. We want to see a new imbalance form. We want to see that imbalance filled. We want to see a demand zone or supply zone retest, depending on whether we're buying or selling. And when we get that retest, we then want to see the fractal confirmation to provide the actual entry for us, which allows us to, number one, refine our stop loss, and number two, get the safest possible entry. That is what the trade looks like in reality. Now let's go and do some back testing. All right, so we're looking at AUD CAD here on the hourly, and I've just located a trade. We have a supply zone just here. This would be a good entry for the sell limit style entry. So let me break this actual kind of context down for you. As we know, we want to look at three things. The trending direction. This is a downtrending market. It actually continues downtrending in the past. We have imbalance. The imbalanced price range that we're looking at here is this candle. As you can see, this is an open price range. There is no wick or body or anything that currently fills this range. So basically above this high that we've just printed on the hourly and below this area of supply, that's the imbalance range in between there. Now, obviously the third thing then is the supply zone. That's where we want to get in. The supply zone is this candle, this indecision candle or consolidation candle before the large downward move. This shows institutional levels of selling entering the market at this point. That is why we get this big drive lower. We are just looking to join that flow. Seeing this as a premium price area that traders were happy to sell at before, we would expect that they will be happy to sell here again. Now for this trade, we're going to keep things nice and simple. This is the most simplistic way to approach continuations. For your target, because the risk reward allows us to, we can simply target this low here, okay? So this would mean if we do get tapped in, we are just looking to take the market down towards this area, this next low in the trend. The reason that this trade is now set up as a good continuation opportunity is because if we get tapped in here, we would expect the market to trade lower due to the fact that we are in an overall downtrend. If, however, the market doesn't do that and it pushes higher, our stop loss will get us out of this trade without taking a major loss, because as soon as this high breaks, we're pretty much wrong on this position. So as long as our stop is positioned there, we're minimizing the downside we can take. But if the market does play to our plan, This is an easy target because it's obviously the next point in the downtrend. If the downtrend continues, this target will be hit, and we get a massive risk-reward profile. So we actually can make $8.53 for every $1 we risk here. So if you were to do this with a $1,000 risk, it could potentially return $8,530 back to you. So what we're going to do now is place this order inside of the simulation. So we need a sell limit order. We're going to save that, and here is our entry. If the market comes into this area of supply, we will be tapped in. Now we are also going to monitor for the confirmation style approach as well. Okay, we're going to do that for any trade that we do take through this phase of downward trending price action. See if we can get confirmations for these trades as well. So we've just pushed down. We've had a very light break of structure here underneath this previous low. This is a closure, so this would now be valid to place a sell limit at this supply zone. So here we've actually had that confirmational shift that we want. We could place a sell limit here, and we would have our stop loss above this high and our target down towards the same target we were looking for on trade number 1. Now for these confirmation based entries, I don't want to double stack position, so I'm not actually going to place an order for this one. We're just going to monitor and see how it plays out, okay? Let's allow the market to run then and see if we get a fill on that second opportunity. We can allow the market to run for a bit. We would only have to step in and identify potential for later executions. Now we have 2 potential working zones. So we can leave the initial sell limit trade to run. But for the confirmation entry opportunity, we have this supply, which we were happy to place a sell limit on. But we've now formed a new supply just here. This new supply obviously has driven price even lower. This is great news for our sell limit, but if you're using the confirmation approach, you won't be in just yet. So this would be an ideal situation to join the trade with confirmations. But the risk is now that the market could potentially push and drive higher towards this point, which would mean a sell limit here could easily be stopped out, even if the trade is correct. Now, the reason I don't like to take positions like this is because if the market is to go all the way up, not only do we take one loss here, but we're also going to lose this position too. So we've turned what was a good idea into 2 losses, which is not ideal. So what I would do at this point is look for something we call fractal confirmation. As we've seen so far, with this market shifting from higher highs and higher lows into lower lows, and ideally now into a lower high, we're going to look for this exact same format, but on a smaller scale inside of here. So we can monitor the pullback towards here, and if we get opportunity to enter, we will. If we don't, we will hold our sell limit order at the top zone, understanding that a market pullback to there could provide us with the opportunity that we want to get into a trade. So let's eliminate this for now because this is not something that we're going to have on at this point in time. Okay, so we've now seen the first signs that we want to see. We've seen our high, higher low, higher high. It's only a wick. We can't use this to validate longs, but we can use it to indicate that a higher high has been printed. And now we would want to see this low broken. This would provide that confirmation entry that we're looking for. To highlight that, it's going to be this movement, okay? That is what we want to see. Then we will sell from supply if we get a pullback. So this just makes our trade a little bit safer. If we approach in this manner, we are going to get the highest probabilities, and we're not going to get ourselves into bad losing trades. Here we can see we have supply. We do have a bit of a wick there, but there is still notable imbalance between the current candle and the supply zone. So this would definitely be a fine place for us to go and place our sell limit. Now you can also go and do zone refinement, which is where you'd go to a lower time frame, like in this instance, 30-minute. But we're just going to keep it simple because we're just highlighting the theories here. So we have our confirmation. We're going to not place this order as we've said, but we will track how this one works out. At this point, because we're placing a new order, we can delete that one. We're going to clear this one to keep it simple. At this point, we can see our sell limit position is running pretty profitably. We have $2,971 in unrealized profits at the moment, which is around 3%. And if we get tagged on this confirmation trade, as we have now, that would be the potential confirmation or fractal confirmation way to get into this trade. So now let's run the market a little bit faster. Both positions are executed, so we don't really need to take our time with it. At this point, of course, you are moving with the overall higher time frame flow of the market. So the best thing you can do is just leave the market to print its lows and just let it do its own thing. There is no reason now to be rushing into opportunities. you can just allow the market to flow, okay? You don't need to rush in, you don't need to panic and get out. You can just allow these trades to flow through, because if the trending direction is correct, that you formulated the trade around, then you are gonna be in for a winning trade. There's no worry about that, okay? So, the take profit was hit on both of these, and now let's take a quick look at the performance of both opportunities. The first one is the sell limit opportunity. Remember what we said about these. You are going to have lower probability of winning because you are not working with confirmations, but you are also going to have higher trade frequency. So basically, pretty much every trade that you find, you will be able to execute, or the majority of them, because you just get in as soon as supply or demand is tapped. So you get a higher trade frequency overall, meaning more wins, but also more losses. Now, if you have a higher risk tolerance, this is a good approach, because you're going to get more trades, you'll win every trade that does work out, and you'll be able to mentally manage the losses that do form as well. For most people though, a lot of people are a bit timid around trading, especially when trying to learn and get into this. So this confirmation approach may be the better one for you. Now this one is of course pretty much the opposite of the risk entry. We have higher probabilities because we have confirmations. We have lower trade frequencies because we're going to miss some trades. You're going to have less wins, but you're also going to have less losses. If you've got a lower risk tolerance, this is going to be the approach for you. Now to take a look at the potential performance then, on the first trade, we have an 8.53% potential return. On the second trade, we have a 9.31. So we actually make around 0.8% more on this second opportunity. By the way, the trades are not always going to be this big. These are some very healthy looking trades because we were given a large range to work with. Anything over 3% is good. You don't always have to be going for 8 or 9, and I recommend you don't always go for that. Work dynamically with what the market provides. If it's a big one like this, that's all good. If it's a 3, then that is also going to be completely fine, okay? So as you can see, we make more money on the confirmation because of the refined stop loss, but there was also the opportunity that we missed this. If we didn't get this confirmation that we wanted to see, we wouldn't have caught this trade. And we also missed the initial execution, which means we would have had to wait maybe a day or two more, another day to actually find this execution, okay? The first one's taken on the 21st, the second one didn't come through until the 22nd. So more patience is required, but you will have that higher probability, lower frequency approach if you do opt for confirmations. Okay, so now looking at where the market is currently sitting, we haven't yet had a real solid breakthrough of this low, so we don't really want to place any sell orders yet. The reason I say this is, although there is a very light closure, there is an immediate reversal, and there is only wicks closing under this low. So this could potentially be what we call a liquidity sweep, which could lead into a potential full-blown reversal. For us to start assessing new positions, we would want to see a nice closure through these lows to confirm that this downtrend is in action. And then we can look for our opportunities to sell into this continuing move. So we do get a little closure there, which is good to see. If we take a look at the existing trending price action, we see that this area is our current range high. We have an open area of supply potentially there. This didn't really break any significant structure until we formed this high, which is now broken through. So what we can do at this point is look towards this supply zone. This is the supply zone that has broken structure and led us into a new downtrend. The idea here would be we could consider looking for shorts from here. And then if the market was to break higher, we may then potentially have buying opportunities through this range until we meet some of the higher supply areas, such as here and such as here. Now, for continuation trades, obviously we want to move with the tight flow. This means if we do break above this high that we've just formed, it's likely that we get some shorter term buying opportunities, at least towards some of the open ranges above. So I'd be happy to look for shorts from where we are, given that we can get a good enough target. Let's just see how the market flows for now. See if we can print any more of a significant low. Okay, we may have printed a low here. No, we still have some ground to move. Okay, so we have our significant low printed at this point. This is all realistically what I would classify as one leg of price action because we've just got a pretty solid movement down. So we're going to look at two approaches once again for a short here. See what we can get in terms of risk reward for a sell limit opportunity. So if we have our stop loss just above the swing high, we're looking at around a 3.37% potential return there. Once again here, what do we have? Imbalance there, supply there, and then our swing low target here for our entry in a predominantly downtrending market. So we could place a sell limit here, and we will also assess for the confirmation style entry once the market reaches into this point. So let's go ahead and place this order. That's what we did last time. And then we will track this from a confirmation perspective as well without actually placing an order and see the outcome of each approach. As we say, if this trade gets stopped out, we may be leading into buying territory to take the market higher towards some of the other open and balanced supply zones that we have, or maybe even into a full-blown reversal past the previous high. So for now, we'll focus on shorts. But one thing you need to understand when you are trading from a continuation perspective is eventually your trade is going to get destroyed. Okay, the market will at some point push and break through your high if you're selling, and you will eventually lead into a losing trade. That is just how trading is, and that is just the natural flow of the market. Right, for us to really validate a short here, we need to see a break of this low. So if we're going for confirmations, this is the kind of movement that we would want to see, okay? We're tagged in on our initial execution now, which is good. Just taking a look at the price action here. The high time frame supply was retested with this small indecision candle here. And we can see that there is some inefficiency towards that area of supply. Okay, so there's still a very tiny amount of imbalance just in there. This, even though it's just a tiny piece of imbalance, is definitely something that I will always consider. Tiny imbalances like that can actually get filled and will usually get filled. Not all of the time, but a lot of the time. So that is where I would be looking for shorts. So if we were looking for a sell here, now that we're following this confirmation, we would have our sell limit on this high. We could have stops above that supply zone high and targets down into the low. Because at this point we've validated, and we've also kind of validated that there's no reason for us to go higher inside of this trend. So let's actually see. Okay, we've been tagged on that. Be nice if this runs down to our targets now. Well, that was a very fast one. And there you go. We've been taken out at the full take profit. So this second opportunity there, you can see the importance of looking at those imbalances. There is no imbalance above in this price range, so there's no reason for the market to return to here unless it's going to break through the highs. We see this very small amount of imbalance. Initially, I didn't see it, and I believed that this was going to be the supply we'd sell from. But when you note this tiny imbalance between the supply and the wick, we understand there's a high likelihood that that's going to be filled, which allowed us, of course, to get this second opportunity. So once again, let's stack these up. In terms of the two sell limit risk entry trades we've taken, which is of course this one here, and then the first position over here, we looked at an 8.53% return on the first one and a 3.37% return on the second one, which leaves us with an 11.847% return over these two positions, which is very, very good. Obviously, as I say, eventually this is going to blow the other way and we will lose a trade most likely. But for now, we are moving naturally with the flow, and we've caught two really nice trades there from a sell limit perspective. Fortunately, both of these trades did provide confirmation entries. The second one has returned 5.38%. The first one returned 9.31. So we're looking at around a 14.69% return over those two confirmation trades. So the confirmations have actually been more profitable than the sell limits. But of course, they've been trickier to catch. And if you didn't have the eye for the market, or you missed these opportunities of actually getting in with the right confirmation or location, then you would have missed the trades. And sometimes it's just going to completely not form, right? Sometimes we are just going to sell off without providing confirmations for those safer kind of fractal entries. So it really depends on your risk tolerances and which approach you prefer to take. Me personally, I am quite a big fan of these confirmation approaches. You get refined stop losses, you get better risk reward, and you have higher probability. So it's a lot less stressful to hold a trade that's double confirmed. But the sell limits are fine too. And there are times where I will take these positions over the confirmational approaches. Now we've come and wicked through this low. We've had no closures. So we ideally need to see a new closure under this low to lead into a next movement. So now let's continue the market through and see if that happens. Okay, at this point we've broken higher. We just had a big push higher. That's pushed us above the previous structural points. Realistically, it's going to be this one. So that kind of puts an end to our selling movements. Okay, this is going to lead into now most likely reversal opportunities where the market is likely to go the other way, which realistically brings an end to our session inside of this bearish continuation trend. Okay, so we've had 2 trades in 2 different scenarios with between 11.8 and 14.6% potential returns on those trades. You are going to lose trades too. You're going to get caught in the mess sometimes. The market will sharply reverse on you sometimes, and you will, of course, just get burned. But the risk reward we're getting here, and the fact that it's so simple to just trade through a natural market cycle, like a downtrend or an uptrend, makes this a very, very nice way to trade. And hopefully, over these examples, I've showed you how we do that. Okay, so taking a look at the analytics on this very small sample size of continuation trading, we made 11.847%, which is $11,847 on a $100,000 account. We only had 2 trades, but the average risk reward across those trades was 5.95, and the ideal average risk reward was 7.86. Now, our maximum risk reward on one of the trades was 8.53, the other one was just over 3%. As we saw, there was potential to run this to around 14% across the 2 trades had you gone for the confirmation-based approaches. The only big thing I want to look at here is the Monte Carlo simulation to see how this system may perform over a long term. Now, you might want to do, and you probably, well, definitely do want to do more samples than 2 single positions. What we're going to do is put the win rate to around 50%, because this is the way that I trade, and my win rates are very close to 50% long term, meaning I win 1 trade and I lose 1 trade. So every 100 trades I take, I got 50 wins and 50 losses, okay? Our average loss, of course, is going to be $1,000. We'll leave the average gain, we'll leave the standard balance, and what we will do is do 5 different simulations with, let's do 100 trades each. So let's say we were to take a trade, let's do 250. So we took a trade every single day of the year using this system, every single trading day that is. We have 50% losses and 50% wins. This is what your performance may look like if you weren't to withdraw a single penny and you were to compound your profits, okay? Now, I would say your returns are not going to be this big. Number 1, because you're going to pay yourself, right? So there are going to be times where you actually take money out of the account. This is if you just compounded everything. And number 2, you probably don't want to compound your risk percentage. At least most people won't, because that is, of course, where you get into the bounds of, risking $5,000 per trade here, and you've never actually paid yourself from your system. So we don't really care too much about the actual numbers. These are quite optimistic. But what we should focus on is the fact that every single one of these simulations, and even let's run 50 simulations, is running positive, okay? So every single one of these has ended the 250 trade period in positive profit. None of them have even any opportunity of going bearish due to the fact that we have positive risk reward working in our favor. Now, let's say our average gain was actually around $3,000. So our average trades were 3%, and the trades we've taken here were just outliers. You will still see with this approach that after 250 trades, it is practically impossible, providing you follow the system, to actually lose. Because at this point, you have positive risk reward weighted in your favor. You lose 1 trade and lose 1%, then you win 1 trade and win 3%. So every 2 trades you take is averaging you 2% in returns. You're making 1% per trade, essentially, over however many trades you take using this continuation system. So this is a great way to trade, okay? Once again, don't worry too much about the optimistic numbers, because chances are you're not going to triple or quadruple your account over the span of a year. You're not going to be compounding your returns, potentially, and most likely you are going to be getting paid out, especially if you're working with a prop firm, because they will pretty much force you to take payouts as well, instead of running up numbers like this. If you want some help to build out a continuation trading strategy, check out the top link in the description. I have a completely free 7-part course, 7 steps to profitable trades. I show you how to build a trading strategy from scratch and how you can build upon that system to improve your trading abilities so that ultimately you can get consistent, get funded, and make some money. So check that out. It's 100% free. If you don't want to do that, there's another video somewhere on the screen right now. Thanks for watching, and I'll see you in the next video.